Welcome to the May Focus series. Today's topic is guiding clients through complex decisions, specifically focusing on retirement planning. Now, when we think about retirement planning, we know that the goal is to help clients achieve the retirement they want with as much certainty as possible. But certainty is difficult. It's influenced by so many different factors. If we just think about everyone on the call today, we'll all have our own views, our own perspectives on what the different levers are and what the approaches and assumptions we should be using in retirement planning. It's hard for experts to agree on the different levers. We can only imagine how overwhelming it must be for clients. But the goal of AssetMap is to surface what are those material levers so that we can open up a conversation between the planner and the client to arrive at the best possible retirement for each client. And if we think about retirement planning, we often think about it in two phases. We have pre-retirement. Here's where the client is still working towards retirement. They're in that build-up phase. And the conversation here is usually around, are they on track? And what are the different behavioral or financial changes they can make to progress towards the retirement that they want? We want to provide clarity and confidence for tomorrow. But when we think about clients that are in retirement already, here the conversation shifts to balancing that sustainability and the lifestyle the client wants. So how do we give them the best possible retirement, but ensure that they can maintain that for the rest of their lifetime? This is also where we talk a lot about later life needs and things like legacy. Now, remember, as we work through this presentation today and we work through the different scenarios, thinking is around how do we surface those levers and really show clients the different options that they have available to them to make sure they can achieve the retirement that they want. So how are we going to focus on that today? We're going to start by looking at a client that is still building towards retirement. What are some of the levers there? How do we surface those conversations? Then we'll work through a client that's in retirement already. And as we work through these different scenarios, we'll look at what are the key planning drivers, but how and when do we surface these different conversations? Right. So let's jump into AssetMap and take a look at a client that's working towards retirement. Right, so here's our first client for today. This is Sarah Thompson. And I want to talk a little bit about what Sarah Thompson has at the moment. So we can see that Sarah is 45 at the moment. She's earning an income here of £48,000 per annum. She's also got a buy-to-let property that she's renting out, and we can see that she's earning £18,000 per annum on that. We know that at some point in the future, she will start to receive a state pension, so we've included that here. And we can see that she's currently contributing to a personal pension. She also has some stocks and shares available, and she's expecting an inheritance in the future. So we put that in as future asset that might come down the line. All right, let's have a look at the retirement planning. So I go across into target maps, and you'll see I've created a retirement target map for Sarah. So the first thing we want to do is once we've created a target map is we know that it's going to come up with an answer based on the default assumptions that we've put in. But now we're going to start to work through that and refine that based on what Sarah's needs are. So here we've said that Sarah needs 60% of what she's currently earning, and we can see that that's $39,600 per annum, and that she would require that from age 65 till age 100, and she would like that to keep up with inflation or cost of living adjustment of 3%. In addition to that, Sarah wants to have funding for travel, so we've earmarked £6,600 per annum, again from 65, but this is until 80, and that needs to keep up with a cost of living adjustment of 3%. Now, of course, this is completely editable, so I can open up these line items, I can change the description to whatever words I want to use, I can update the amounts, I can update the start and end ages, and even the inflation figure. I can also add additional needs if Sarah requires it. So this first section is about really defining what does Sarah ideally want retirement to look like. Once I've done that, you'll see that what it's telling me over here is that if this is the desired retirement that Sarah wants, she would need a total capital today of £752,000 if we assume a growth rate of 5%. But that is step one, defining the need. The next step we're going to look at is what does Sarah have already that we can put towards this goal? Now, if we have a look at what Sarah's got, we can see that she is receiving this rental income. But even though Sarah is receiving it now already, she's not saving that towards retirement. Perhaps she's using that to fund the mortgage or fund other costs or as part of her monthly budget. But we don't want to put it necessarily towards retirement from today because it's not being saved for the period from now till she retires. But we do want to include it in retirement. So part of the income that she requires can be funded by this rental income in retirement. So you'll see here we've included it, but only from age 65 till age 100. Again, assume that it's going to keep up with an inflation of 3%, and we've also deducted some taxes there at 20%. We've also included the fact that she will receive that state pension. It'll be from age 67. We've again assumed that that will continue till age 100, keeping up with inflation, less taxes. And she's still currently contributing to that personal pension at an amount of £2,400 per annum. So we are including that contribution from now till age 65, again increasing by inflation, and we're deducting tax. If we go down and look at the assets that she has, you'll see that we've included the personal pension by selecting it here on the left, as well as the stocks and shares. We haven't included any of the properties. We're assuming she's going to keep those properties, and we haven't included the inheritance, although that is something we could bring in as part of the conversation with Sarah. So the first thing we're doing is looking at what is it that Sarah needs, then what can we allocate towards this goal. You'll see that the third tab here looks at what does that mean. So it gives us a nice summary on the left-hand side. This is everything Sarah wants for retirement. And on the right-hand side, this is everything that we can allocate towards this retirement goal. And what is it telling us? Well, it's saying that at a 5% expected return, Sarah is 74% funded towards retirement. She would need an additional £196,000 today, or she would need to save £985 per month for the next 20 years, keeping up with inflation. Now, that's the starting point. Of course, now we're going to start to look at the different levers. What are the things we can do differently to help Sarah progress along this bar and have the retirement that she wants? But before we jump into that, I just want to talk through this fourth tab here. This is going to show us the cash flow. So the bars here represent the income that Sarah requires year on year. The blue is showing the incomes that the client is receiving in retirement. So in this case, it's that rental income as well as the state pension. And while that is partly funding her need, it's not quite enough for what Sarah needs. And the difference is being topped up by the green, which is her investments. And we can see that that is running out here in 2056. So this cash flow always runs from 1st of January to the 31st of December. So this first year that we are now 2026 is for the remainder of this year. And we can see here that in the first year, this is the amount that's being contributed that we can add into the pot of funds. And this is the amount of assets that we're starting with, those two investments. And that gives us an end of year capital balance of £114,000 with growth. Each year, we're adding to the pot with those contributions to the pension fund as well as growth. And we can see that that pot of funds is growing year on year on year until we get to age 65 and Sarah starts to draw from her investments. So here we can see the amount that is being drawn. That's obviously with inflation. We can see that part of that is being funded by the rental income as well as the state pension, but it's not quite enough. And the difference here of 58 in this year 2047 would need to be funded by the capital. We can see how that changes that capital balance year on year until that capital runs out here at age 74. Another key thing about this cash flow is we can expand these sections. So I can expand the capital required, and I can see exactly how much the living expenses is at retirement, with inflation as well as the travel. I can also expand the after-tax cash flows to see, the rental income is not being included now, nor is the state pension, but she is contributing to that personal pension. And then I can see at age 65, those contributions stop, but she starts bringing in the rental income as well as starts receiving that state pension. And we can see the impact of that here. And once you've expanded the cash flow, you can also click on the links here and you can edit it straight from here, straight from in the cash flow. So if you want to make any changes to see the impact or stop something earlier, start it later, you can always click here to adjust. Exactly the same with the rental income, for example. All right. Let's talk a little bit about the taxation. I'm going to go into it a bit more as well. But how the model works is under the what you want section, we want to define exactly what it is this client wants to receive in their pocket. And then under the what you have section, you'll see that there's a loss to taxes column where we deduct tax from incomes as well as from assets. The reason we do that is that we want to compare apples with apples. What is the client's net need in their pocket? And then with the assets, we strip out the tax so that we can work with what is left. Now, of course, these tax figures are adjustable, so you can change it depending on the clients. And I'm going to talk a little bit more about tax in the next scenario as well. But from the starting point is that we deducted off the assets, say that's lost to tax, that's owed to the taxman. We can work with what's left, and we want to answer the question of if this is what I need in my pocket, and these are the investments, assets, incomes that I have net of tax, how long can they provide for that need? But now we can start to create different scenarios. So we can clone here on the top right. And what that's going to do is just make an exact copy. So now you can see I've got two retirement target maps for Sarah. They're both identical. But here I can start to do something different. So I can say to Sarah, well, what if we target a higher return? Now, obviously, that's a conversation to have with Sarah around, what are the risks that she can afford to take? What is the risk that she's comfortable taking? Can we target a higher return? But that is one of the levers and conversations that I can surface around what is the difference if we target a higher return. I can also rename this scenario by clicking on settings here. I can change it to say this is at a 6% return assumption and update. And you'll see what that'll do is update the name here. So that's one of the levers. I can then clone this again and look at a different potential option. So here we've got, our starting point. Sarah was 74% funded. If we target a 6% return, we can see that Sarah is now 80% funded. We have a look at the cash flow, we can see that it's lasting a bit longer and running out around 2058. But what are some of the other levers that I can work with? We've looked at targeting a higher return, but we could also look at saving more. So as part of the conversation with Sarah, we could look at increasing these personal pension contributions. What if we did an extra 50 or 100 pounds a year and we bumped this up to 3,000 per annum? What would the impact be of saving more? See, as I adjust that, we can see how this goes up. So it makes a small difference, not massive there. Or maybe perhaps Sarah says she can save into a discretionary investment and we want to bring that in. I can add additional savings here. I can say it's additional savings. Let's say that is another 6,000 per annum. And we're going to start that now at 45 until 65. And we're going to increase that by 3% each year. And let's also take off some tax from that. Once I create that, you can see it adds it to the pot and we go to 95% funded. So I can look at saving more. I can look at, on this side, on spending less as an option. We can look at retiring later. So I can say instead of, retiring 65, what if we push this out to 67? And I can see the impact of that. So what if we started drawing only from 67 and we also changed the travel to 67 and worked a bit longer? what would that look like? And we can see now we get to 105% funded. So you'll see that by creating these different scenarios, I can start showing Sarah the different levers and the impacts of that and have those trade-off conversations. Maybe it's more important to Sarah to retire earlier. She'd rather take less income, save more now in order to achieve that. For another client, they might be comfortable working longer and being able to, save a bit less or maybe take on less risk. So we can work through these different levers with the client and arrive at the perfect answer for them. Again, I can update the name here and I can say this is a 6% return, working till 67 and saving. So we can really name it exactly what those changes are and see the impacts. And then if we go back to this page, we can see that this page starts telling a story. Now I can drag this up to the top and say, that's our starting points. This is what it looks like if we target a little bit higher return, and look what it looks like if we work a bit longer and save more. I can also show this to Sarah as a compare scenario. And to do that, I simply check these boxes here on the right-hand side and select compare. Then brings it up in the screen and I can go through that conversation again with Sarah. Remember, this is our baseline. This is if we do nothing. This is what it looks like. Look what happens if we take on a bit more risk. Look what happens if we save a bit more and arrive at the answer for her. All right, so that's looking at a client in that build-up phase and creating different scenarios to highlight and surface those material conversations around what are the behavioral or financial changes the client can make to achieve the retirement they want. Before we jump across into a in-retirement example, I want to just talk through tax in a little bit more detail. So I've created just a very simple scenario to highlight this conversation. We've got the same client. Let's say they've got a pension fund of £600,000 and they're drawing $24,000 per annum. A lot of time we get asked the question, the way in which we tax in Asset Map. Under what you want, we show the net amount that the client wants to receive, and we take off the tax from the assets today. We default that to 20%. Of course, that is also editable, but the default is 20%. And the question we often get is, are we not being overly conservative by deducting the tax off now and using the net asset? Because aren't we then missing out on the growth that would have accumulated on that tax deduction? And I want to show you here in two examples the two different methods that you could use and how the answer comes out similar. So I'm going to go across into target maps. And this first scenario here, I've left it as the default. So I've said Sarah is drawing $24,000 per annum from now till age 100. And then under the what you have section, you'll see that I've put in the £600,000 asset here, and I've added in 20% loss to taxes. We can see that it's coming off immediately. The outcome here is that the client is 78% funded. And we can see that it's running out in year 2051. But what if I used method 2, which is instead of taking the tax off the asset now, we take it off when the client draws the income from the asset. So here I've just shown another example where under what you want, we've put in the amount that Sarah wants net in her pocket, which is this $24,000, but we've added an additional line item to show that there will be tax as and when you draw the income, and that we've used that same percentage of 20%. You'll see in this example, under the what you have, I've left the loss to taxes at 0. And what you'll see is the outcome is the same. The client is still 78% funded, and it is still running out here in 2051. And the reason for that is, even though it feels like we're taking the tax off now and we're losing out on that growth, actually the growth that happens on that tax in the end goes to the taxman in any event. So both scenarios will come out the same. What you will see is different though is the deficit amount. In this example, the deficit here is net of tax. What is the shortfall net of tax? And here the deficit is gross of tax. So whichever method you feel more comfortable with, deducting the tax off the asset or deducting it off the income, the effect is the same. What is important to understand is what is that rate that you use? What percentage do we deduct? And that's also difficult. We don't know what tax is going to be like for the next 20, 30, 40 years, but we make an assumption today. We default it to 20%, but if you feel like a client's effective tax rate is going to be higher than that or a lot lower than that, you can obviously adjust that percentage. Where it does make a difference is if the client has got, going way overfunded, we're assuming that we're using all of that retirement savings. But if the client is over 100% funded and there is going to be funds left in the event of death, then in this first method here, where we take it off the asset, we would have already accounted for tax. Whereas if you take it off the income, whatever's left would not have tax deducted as yet, but we feel like that would be for the dependents account in any event. So either way, it works. So the key thing with tax is we need to make an assumption that is defensible. We want to, apply tax. We want to take tax into account, but whichever method you use, the outcome is the same. And it's more around that conversation around what tax rate do we use? What does the client feel comfortable with? And most importantly, that we review that just like we do all other assumptions in the planning, that we review that each year to see whether we need to make any adjustments. All right, so that's a little on tax. Now let's take a look at a client that is in retirement already. So here we have Jack Thompson. Now, the conversation in retirement is always a little bit different. We've got a client, they're receiving different incomes from different sources. And often the question is, can the investment sustain that income? And can it sustain it for the rest of that individual's lifetime? So let's take a look at what Jack has. If we have a look here on the left, we can see that Jack is drawing $4,400 per annum from the ISA that we see over here. And that is to fund holidays or travel spending. We'll see that he's also receiving an income from his pension. So he's drawing out this $12,000 per annum from the pension over here. He's got a defined benefit pension fund that he receives $5,300 per annum from. He's also got the state pension as well as rental income that he is receiving from this rental property over here. So if we think about the question for Jack, we can see that some of those incomes, are sort of guaranteed, like the defined benefits, rental income, maybe not guaranteed, but we want to bring that in and see the impact of that. And then some of these incomes that he's receiving is from investments, and we want to understand whether they can provide that income for the rest of his lifetime. So go across to target maps, and I'm going to open up this first retirement funding scenario. And here we can see that we've put in what he actually requires. So he said to us, he would actually like, he thinks, the next 10 years is going to be the best 10 years of his retirement. He wants to do as much as he can in those 10 years. So he actually wants to increase the income that he's receiving. He would like to receive £44,000 per annum. And of course, we want to make sure that that lasts from now till age 100. And again, that it keeps up with inflation at 3%. In addition to that, we want to make sure he's got £5,000 per annum for travel, and that's only from 70 to 80. So that's that first 10 years. And of course, must keep up with inflation. Now the next point comes in. We said, now we've defined what it is that Jack wants retirement to look like, but what do we have that we can put towards it? And often the question we get here is, which incomes do I include? Which do I not include? So let's have a look at that. We know that Jack is going to be receiving this defined benefit income. So that we want to include. That's a guaranteed income. It's not being drawn out of an investment. He is receiving that year on year. And we've assumed that he'll receive that from now till age 100, that it will keep up with inflation at 3%. And we've deducted 20% for taxes. We also know that Jack's receiving a rental income of £6,300 per annum for the same period. We're going to assume that that increases by inflation. Again, that's a conversation around, will those increases keep up with inflation? Can we sort of bank on receiving that? What happens if we don't receive it for a certain period? How does that impact the plan? And we're going to include the state pension. But we're not going to select the pension income or the drawings from the ISA because both of these incomes are not guaranteed. They are what we're drawing out of an investment, and they can only be sustained as long as that investment is sustained and can sustain that income. So we're not going to include the pension or the drawings from the ISA. We are, however, going to include the SIP and, the personal pension and the ISA. And here I'm going to adjust the tax to say that we're going to take 20% tax into account on the personal pension. And of course, the ISA is tax-free, so I'm going to make that 0. So that's what we're bringing in here. And we can see that based on that, we can see that Jack is 88% funded for retirement. And we can see that the funds are lasting until about 2048. Not quite until Jack is 100. And we want to make sure that we can last all the way here. So what are some of the things we can do? Of course, the one option is we can target a higher return. So we can say, with those two investments, what if we target a return of 6% instead of 5%? That gets us a lot closer to being 100% funded. But what are some of the other things we can do differently? And one of those things in retirement is looking at the income patterns, looking at what sort of income the client is drawing at different times in their life. And a nice approach to that is something that, they call the go-go years, the slow-go years, and the no-go years. So I've put that in here. But we know that for Jack, that first 10 years of retirement is the most important for him. That's when he really wants to do all the things on his list. So here we've said, let's keep that at 44,000 per annum for those first 10 years, as well as 5,000 for the travel. But then after 10 years, from age 80 to 90, we think we can reduce that need. Jack won't need as much income for that period. And then in the later years, from 90 to 100, we can reduce that a bit further. But we also want to make sure that we're accounting for care that he might need later in life. So we've made it 33,000 per annum. But the key point I want to show you is how you can stagger the client's needs. What do we need for the first 10 years? Maybe it's different for the next 10 years. What return are we targeting? Again, using these target map scenarios to highlight and just bring out what are these material levers that we can adjust and show that to the client. So by doing that, we can see that Jack is now 100% funded for retirement and it is not running out. And here you can see how that income fluctuates over time. Okay. All right. And ending today, I just want to say thank you very much for joining, for watching this recording as well. What we want to show you in target maps for retirement planning is just how we can surface those conversations, whether the client is working towards retirement, whether it's in retirement. What are the different material levers that we can use and create scenarios to show the client, look what happens if we save more. Look what happens if we spend less. Look what happens if we target a higher return. But really to surface those conversations that clients feel like they understand and they feel empowered to make those changes to move them forward. Thank you so much.